So I'm going to go back to the textbook and we're going to go to page 18 before we handle this next one. Now, there are often times when one company purchases another, business transactions that take place between the two. So let's read this. Sometimes it's the best way to make sense of it. Many equity acquisitions establish ties between companies to facilitate the direct purchase and sale of inventory items. Such intra-entity transactions can occur either on a regular basis or sporadically. For example, Coca-Cola recently disclosed sales of $7.1 billion to its equity method investees. Regardless of their frequency, inventory sales between investor and investee necessitate special accounting procedures to ensure proper timing and revenue recognition. An underlying principle of accounting is that revenues are not recognized until earned, and revenues are considered to have been earned when the entity has substantially accomplished what it must do to be entitled to the benefits represented by the revenues. In the sale of inventory to an unrelated party, recognition of revenue is normally not in question. Unfortunately, the earning process is not so clearly delineated in sales made between related parties. Because of the relationship between investor and investee, the seller of the goods is said to retain a partial stake in the inventory for as long as the buyer holds it. Thus, the earning process is not considered complete at the time of the original sale. So, income recognition has to be deferred until substantial accomplishment is proven, which means the subsidiary sold the goods. When the investor applies the equity method, reporting of the related profit on intra-entity transfers is delayed until the buyer's ultimate disposition of the goods. When the inventory is eventually consumed within operations or resold to an unrelated party, the original sale is culminated and the gross profit is fully recognized. In accounting, transactions between related companies are identified as either downstream or upstream. Downstream refers to the investor's sale of an item to the investee. So the investor selling goods to an investee is a downstream. The investee selling goods to the investor is an upstream sale. Okay, page 19, do you see that?
Yes, I do.
Although the direction of the intra-entity sales does not affect reported equity method balances for investments when significant influence exists, it has definite consequences when financial control requires the consolidation of financial statements, and that gets discussed down the road. So, we're going to look at downstream sales and upstream sales. Assume that major company owns a 40% share of minor company and accounts for this investment through the equity method. In 2015, major sells inventory to minor at a price of $50,000. This figure includes a gross profit of 30%, or $15,000. By the end of 2015, minor has sold $40,000 of these goods to outside parties while retaining $10,000 in inventory for sale during the subsequent year. The investor has made downstream sales to the investee. In applying the equity method, recognition of the related profit must be delayed until the buyer disposes of these goods. Although total intra-entity transfers amounted to $50,000, 40 of this merchandise has already been sold, thereby justifying the normal reporting of profits. For the 10,000 still in the investee's inventory, the earning process is not finished. So basically what happens here is, in this scenario, the remaining $10,000 of inventory at a 30% profit rate, or $3,000, and again, the investee only owns 40% of that, they need to show an unrealized intra-entity gross profit on the books. Do you see how they have to adjust for those transactions that have not fully been satisfied in the books? So as you can see here on this journal entry, the way in which we will handle that is a debit for the equity account. Think about it. Normally, on our books, on the investor's books, their equity has been increased because they promoted the sale. But because it was to the subsidiary, they're going to need to show on the parent books a debit, reducing that equity section in the stockholders section of that $1,200 because it truly hasn't been earned yet. And then we'll credit the investment because we're basically taking away those earnings. We're reducing the asset of the investment account. That's because the earning process has not been completed in full. Then, on page 20, in the subsequent year when the inventory is consumed or sold, the deferral is no longer needed, and you create that journal entry to offset it. Initially we debited the equity, credited investment, now we're going to offset it, go back. That's for downstream. For upstream, unrealized profits remaining in ending inventories are deferred until the items are sold or used. So in this example, an upstream sale means the investee sold to the investor. Okay?
Okay.
In this case, major company once again owns 40% of minor. Minor sells merchandise costing $40,000 to major for $60,000. At the end of the fiscal period, major still retains $15,000 of these goods. Minor reports net income of $120,000. So in this case, to reflect the basic accrual of the investee earnings, the investment in minor, 40% of $120,000 is $48,000 with a credit to the equity. Then what we need to do is look at what has not been realized yet. The amount of the gross profit remaining unrealized is basically what's left in their inventory, $20,000 divided by $60,000. Excuse me. The gross profit percent, let me see how they sold major, they sold it for $60,000, they purchased it for $40,000. So that's how they can tell what their gross margin is. 33%, because they're marking it up, okay, to sell it. So the amount sitting in ending inventory for major is $15,000. But if we come up with what is the gross margin on that $15,000, it's $5,000 of income. And again, we own 40% of this company, okay? Not all of it, we own 40%. So we will have to create a journal entry to show this unrealized intra-entity of $2,000. So we'll show a debit again to equity and investee income, and then we'll credit our investment in the minor company. Then once the transaction does happen, it gets reversed. So it's basically going to be treated in the same fashion. So let's go and see what So number 10, Perez applies the equity method for its 25% in senior. During 2015, Perez sold goods with a 40% gross profit to senior. Oh, then senior sold all those goods. Yeah. So nothing needs to happen there. Now let's look at number 11. Panner owns 30% of Watkins and applies the equity method. During the current year, Panner buys inventory costing $54,000 and then sells it to Watkins for $90,000. So this is a downstream sale. At the end of the year, Watkins still holds $20,000 of the merchandise. What amount of unrealized gross profit must Panner defer in reporting this investment using the equity method? So the first thing we want to do is figure out what the gross profit rate is. So they bought it for $54,000 and they sold it to Watkins for $90,000. So their gross margin on this sale is $26,000, or is it 54 minus 90? $36,000 is the profit. So $36,000 divided by $90,000 is 40%. Let me just, we'll go through this.
Yeah, that's 40%.
So we're going to say, to figure out the gross profit rate, we're going to take the $36,000 profit, divide that by $90,000 is going to give us a 40% gross profit rate. So the inventory still remaining on the books at the end of the year is $20,000. Okay?
Yeah.
So inventory remaining at year end is $20,000. The gross profit rate is 40%. So the what we would call unrealized gross profit the unrealized gross profit is going to be $8,000, isn't it?
Right. Yeah.
But then we need to determine their share. Their ownership is 30%. Therefore, the intra-entity gross profit deferred is going to be $2,400. Does that make sense how we figured that?
Yeah.
We first have to calculate the gross profit rate. Then we calculate how much inventory is still on hand. So we come up with the total gross profit that should be unrealized, but we only allocate it to our share of the ownership. So that $2,400 would be the amount we defer. Now, let's look at number 12. Alex Inc. buys 40% of Steinbart Company on January 1st for $530,000. The equity method of accounting is to be used. Steinbart's net assets on that date were $1.2 million. Any excess of cost over book value is attributable to a trade name with a 20-year remaining life. Steinbart immediately begins supplying inventory to Alex as follows. So they tell us the cost to Steinbart, but then what they sold it for. So that the first one, if we look here, the gain on this transaction is $30,000. $30,000 gain divided by the transfer price of $100 would mean a 30% profit, right? Mm-hmm. Then cost to Steinbart of $96. The transfer price of $150 to me would mean that the 54 minus 150 means 54,000 is the profit. 54,000 divided by the 150 is what our gross profit rate is going to be. So we've got a couple pieces all coming together here. Okay? We've got to deal with the trademark, and then we're going to deal with this intra-entity transactions that may be needing to be deferred. So, we need to, let's set this up and take it one step at a time. So, the first thing we're going to do is let's go and look at what did they purchase 40% of Steinbart for. Alex purchased it for $530,000. So we're going to say purchase price of Steinbart shares is $530,000. Then we need to go and see the equity method is used. Steinbart's net assets on that date were $1.2 million. So if the net assets are $1.2 million, we're going to determine what 40% of $1.2 million is, aren't we? So book value of Steinbart is $1,200,000 at 40%. So, where's my equal sign? Equals 1, 2 times 40. What am I doing wrong? 480,000. Okay? The excess of purchase to book is going to be a trade name. 50,000, perfect. Now that 50,000, it told us it had a remaining useful life of 20 years. So we're going to amortize this 50,000 of 50 divided by 20 years is going to give us basically amortization of $2,500 a year. Okay? So that is the amount we're going to need to reduce into the investment account. Now we've got another step. We need to talk about these intra-entity transactions. Okay, so the first one shows The cost to Steinbart is 70, the transfer price is 100. So that technically means the 2014 gross profit rate is going to be 30,000 divided by 100,000, or 30%. Okay? The 2015 gross profit rate is going to be 54,000 divided by 150,000, or 54. %36 on each of those various transactions. So, we need to, question here is, what is the equity income in Steinbart to be reported by Alex in 2015? Okay? So our job is to figure out the equity income to be reported in 2015. So, in 2014, we're going to need to know that this 25,000 held by Alex at year end times the 30% times our ownership of 40%. It was deferred in 2014, but what happens in 2015? It got sold. So we're going to have to then claim that as income in 2015. See what I'm saying? And then in 2015, this 45,000 times our gross profit rate of 36% times our ownership of 40% is going to be deferred. Okay? So, as we go back here, our job is to calculate the 2015 equity income in Steinbart. We start by showing our income accrual, and our income accrual means Steinbart reported net income in 2015 of $110,000. So the first thing we're going to do is take the $110,000 times our ownership. 110 times 40% is 44,000. Okay? Then we need to talk about dividends. The dividends show they declared 30,000 in dividends each year. The dividend I'm screwing myself up and I'm sorry. The dividend is used in the asset account. Okay? We reduce our investment in the subsidiary by the dividend on our books for asset purposes. But for pure income from the company, we're not going to show dividends because they're just giving us back a portion of our investment. So the question here isn't what is the investment account on the books. It's how much money do we really show as income this year, in this year. So we're going to take our 44,000 because that's our share of the investees' net income times 40%. Then we have to take this amortization we do each year and reduce our income by that amount.
Okay.
So we're going to take our amortization from the trade name of $2,500. Now, that deferral in 2014, we need to show on our books today. Now, the deferral was $25,000 at 30%.
40%.
Times 40%.
3,000.
3,000. So we need to add the 2014 unrealized gross profit that became realized this year. Okay?
Yeah.
Realized in 2015 of 3,000. Now we're going to have to subtract the deferral of 2015 unrealized gross profit. And the way we're going to determine that is 45,000 times 36% times 40%.
You get 6,480.
Oh, good. It's minus 6,480. So the equity income in Steinbart for 2015 excuse me, is $38,020. Now, where I screw up, and I do this all the time, the only time we take into account the dividends is to show the true asset
Okay.
on the books of that company. But for purposes of income, we don't care what we receive. We just want to show our percent of all the income. Okay? So again, if you can say, we're doing the same thing, we're just adding more complexity to it.
Yes.
Now, let's look at 13. On January 3rd, 2015, Madison Corporation acquired 40% of the outstanding common stock of O'Toole Company for $1,160,000. This acquisition gave Madison the ability to exercise significant influence over the investee, which means equity method. The book value of the acquired shares was $820,000. Any excess cost over the underlying book value was assigned to a copyright that was undervalued on its balance sheet. The copyright has a remaining useful life of 10 years. For the year ended December 31st, 2015, O'Toole reported net income of $260,000 and declared cash dividends of $50,000. At December 31st, 2015, what should Madison report as its investment in O'Toole under the equity method? Do you see how this question is different from 12? 12 says, what is the equity income? This one says, what are we going to show as an investment? So we're going to go back to what we were doing earlier, where we are going to subtract out the dividends to keep track of our investment in this company. So we're going to look at the purchase price of, what's the name of this company? Of O'Toole. $1,160,000. Okay, that's what we're purchasing, and we're purchasing 40%.
Right.
Now, the book value of the acquired shares is $820. Now, it's not telling us the entire book value for the whole company is $820. It's telling us, based on the shares we bought, the book value is $820. Okay? So we're going to show the book value. Let me go over here. Purchase price, $1,160,000. Book value is $820. Excess, purchase over book, is $340,000. Now this $340,000 is a copyright with a 10-year remaining life, which basically is $34,000 a year. Okay? So that's why we needed that information to get us there. So this is the annual amortization, and this is the life, number of years remaining. So we needed to figure that out to figure out how much we need to reduce each year from the investment. So we started this investment with $1,160,000. Now we need to look at our share of the income, which is net income of $260,000 times our 40%. Okay, so our equity income in sub at 40% is $104,000. Then we need to show the amortization, right?
Yeah.
Of the copyright, and that is going to be $34,000. Then we need to show the dividends, and they paid out $50,000 in dividends. Our share is 40%, so $20,000. So our investment account balance, an asset, see what I'm saying here?
Yeah.
Is $1,210,000. If they asked us, what was the equity income reported for 2015, we would take the 104, we would subtract the 34, right?
Yeah.
That's it. That's what our equity income is. But they're asking us what the asset
We
is.
have, right, in the investment.
Correct. Okay. Now we're going to add something else. There are at times income that is listed in the books as OCI, other comprehensive income. They have to be included in the comprehensive income, but they ultimately do not show up as net income. They show up in the equity section or the retained earnings section of the financial statements. So when we're dealing with this OCI, other comprehensive income, it it mainly deals with items that are not realized yet, kind of like what we did with our profit.
Okay.
So we need to look at how we will take into account any other comprehensive income that an investee will show, okay?
Okay.
And how that will affect our reporting. So, there are reasons that there can be this other comprehensive income, but we're just mainly going to look at how do we add this new piece to our situation. So, if we go to 14,
Okay.
on January 1st, Fisher Corporation paid $2,290,000 for 35% of the outstanding voting stock of Steel Inc. and appropriately applies the equity method for its investment. Any excess of cost over Steel's book value is attributed to goodwill. During 2015, Steel reports $720,000 in net income and $100,000 in OCI loss. Steel also declares and pays $20,000 in dividends. So we're going to do two different things. The first thing we have to do is figure out how should Fisher report its investment in Steel on the balance sheet. Again, this is an asset. Then the next portion is what amount should Fisher report as equity in earnings of Steel on its income statement. So we got two different pieces here now because of this OCI.
Okay.
So we're going to pick it apart slowly. As far as the investment goes, the asset piece only, we're going to start with showing what we paid for it. Then we're going to add the, we're going to calculate, we don't really need to do anything right now with our goodwill. Think about it, because goodwill is not amortized.
Right.
We're going to take our portion of the income and our portion of the OCI loss, and then determine our dividends to show what's sitting on the books as the asset. And we're just looking at the asset piece right now, not the income. So the purchase price, $2,290,000. The equity for the income accrual was $720,000. So $720,000. Oops. Times 35%.
Yep, is 252,000.
252,000. Then we have an OCI loss, and that is $100,000, and our share is 35%.
Or 35,000.
Minus 35,000, and our dividends, they paid out 20,000 in dividends at 35%, or 7,000. So in our asset section of our balance sheet, we're going to show investment in Steel as of December 31st, 2015 to be $2,500,000. Now it asks us, what is our equity income of Steel? Now, what we're asking is just what are we truly showing in income on the books? We're not gonna deal with anything to do with that OCI. All we're gonna show for our equity, that's our balance in our investment account, what we just did. But if we look over here, our income, our equity income is really only gonna be 35% of 720.
Right.
And that's it. We don't have to subtract any amortization because it's goodwill.
Right.
So that is just the same as our percentage of the income. Makes sense? If you need a break, tell me,
Okay.
because this is how, here I'm gonna